The elements of financial statements, that is assets, liabilities, owner equity, revenue and expenses, serve as input into the basic accounting equation. The balance sheet on one side has assets, which are the economic resources of the business. On the other hand, there are liabilities and owner equity that represent the claims on those resources. Of course, owner's equity represent a residual claim and liabilities have a senior claim on the resources, that is the asset of the business. Rearranging the accounting equation, we get owner's equity as the difference between assets and liabilities. Owner's equity is a residual claim on the assets of the business. We can expand the basic accounting equation further, as owner's equity at a given date can be classified by its origin, that is the contributed capital by owners, or retained earnings in the business up to that date. Though it's a bit simplification, as in reality there may be other items in the owner's equity section, such as treasury stock and accumulated other comprehensive income. Treasury stock is a contra equity account that arises when the company buys back its own shares from the shareholders. Comprehensive income includes all the income of the company. Some of the items of the comprehensive income are not reported in the income statement. These are called other comprehensive income. Other comprehensive income arise when there are changes in the value of assets or liabilities that are not reported in the income statement, such as currency translation gains and losses, as well as unrealized gains or losses on the sale of available for sale securities. These amounts as other comprehensive income are contained in the accumulated other comprehensive income on the balance sheet in the equity section. Retained earnings represents income that has not been distributed to shareholders or the owners of the business over time. These are earnings available for distribution to shareholders or owners if the company desires so. Retained earning is the component of owner equity that links the balance sheet equation with the activity equation of the income statement. However, we do not separately have an activity equation for the income statement. Rather, we adjust the retained earnings for any addition or subtraction, that is revenues and expenses, in the balance sheet equation. Net income represents the difference between revenues and expenses. The expenses include both operating and non-operating expenses, and it represents the bottom line, that is the amount of earnings available for distribution to shareholders as dividends. The company may pay out all its net income as dividend, or it may have a dividend payment that is less than 100% of the net income. At times, a company may declare more than 100% dividends. In that case, the dividend paid is more than the net income, which means that the company will be utilizing past retained earnings to make up the difference between the net income and the dividends. Otherwise, if the dividends are less than net income, there will be a net addition in retained earnings. If the net income is less than dividends, in that case retained earnings will drop. So, ending retained earnings are equal to beginning retained earnings plus net income minus dividends. Expanding the basic accounting equation further, we get net income as the difference between revenue minus expenses from the income statement. We know that income statement is the statement of financial performance for a period of the business. The financial performance may be indicating a net income or a net loss. This expanded view of the basic accounting equation now presents the income statement and the balance sheet combined. This leads us to the double entry accounting system. That means that for every transaction there are at least two accounts affected. This is essential for the balance sheet equation to balance on both sides. Here we have an example to help us understand the links between different financial statements. We have the ABC company balance sheet as on 31st December 2010, for example, total assets are 2000, liabilities are 500, owner's equity is 1500, and retained earnings are 250. For the year 2011, the income statement shows revenue of 250, expenses of 50, so we have a net income of 200 for the year 2011. Now here we have the statement of retained earnings for 2011. The beginning balance of retained earnings from 2010 is 250, and we have net income from 2011 income statement 200. There are no dividends given, so we are taking it 0. So the ending value of retained earnings is 450 at the end of 2011. The balance sheet as on 31st December 2011 is showing assets worth 2200. The 200 increase represents the change in assets that is attributable to transactions not related to suppliers of capital, that is net income, which is the difference between revenues and expenses. On the liabilities and equity side, we see liabilities are the same, contributed capital is also the same, retained earnings we see are 450, which is the closing balance from retained earnings for 2011, and the owner's equity has increased to 1700, which is a 200 increase from last year. So we see that on the liability side, equities have increased by 200 and assets have also increased by 200. The increase in asset is not due to transactions with suppliers of capital, that is creditors and shareholders, but due to revenues and expenses, as net income here is positive, so therefore assets show an increase of 200. The information provided on the previous slide suggests that ABC made cash sales of 250 in the year 2011. It made payment of $50 for expenses in cash. So there was a net increase in cash and assets of $200. That is how total assets increased from 2000 in 2010 to 2200 in 2011 on the previous slide. The accounting system is based on accounting equation. The structure of an accounting system mirrors the basic accounting equation, which is assets are equal to liabilities plus owner's equity. The accounting equation balances after every transaction, and the same is expected of an accounting system. An account, as we know, is the classified record of transactions related to a specific asset, liability, owner equity, revenue, or expense item. Each transaction in the accounting equation is entered in a new row. Columns are organized by account so that we can identify which account is of which type. At any point of time, the subtotals provide information that can be used to prepare financial statements. To understand how the accounting equation works, we use the same balance sheet of ABC company that we used in the previous slide for the year 2010. We are assuming that all assets are in cash, that liabilities include account payable, and owner's equity is contributed capital of $1250 and retained earnings of $250. This is our beginning balances of the assets, liabilities, and owner equity. There were two cash transactions in the year 2011. First one was that the company made cash sales of $250, and we see that here we have cash received from services is $250. That is an addition to the beginning balance of cash. And then we have $250 also in revenue that is being added to retained earnings. As we discussed, the accounting equation is on the double entry system. So we have two entries for every transaction. That is, every transaction involves at least two accounts. The second transaction involved payment of cash expenses of $50. So we see that cash is reduced by $50 here as a line item, and also retained earnings have a reduction of $50 due to expenses. So we see that these two entries are representing income statement or profit and loss account here. In other words, the net income from the profit and loss account. And if we calculate the subtotal, it will give us 2200 in closing balance of cash, 500 accounts payable, contributed capital of 1250, and retained earnings closing 450. That is exactly the closing balance sheet for 2011, which shows 2200 in total assets, 500 in liabilities. Now, the income statement for 2011 comprised of two entries, that is the total revenue of 250 and total expenses of 50, which resulted in net income of 200, which was then taken to retained earnings. As we discussed previously, that the retained earnings connect the balance sheet and income statement, so we see that there is a closing entry where the net income from the income statement is close to the balance sheet, that is retained earnings. So the only difference from this slide to the previous slide is that here we have a closing entry from the income statement to the balance sheet. That is, the net income from the income statement is close to the retained earnings, and hence we see the closing balance of retained earnings change from 250 to 450. In our example of the ABC company, we assume that all revenues are received in cash and all expenses are paid in cash. However, this is not the case in reality. Businesses incur expenses, but they are not paid until a certain time period. Similarly, revenues are earned, but they are not received in cash. Cash basis of accounting is followed, then no transaction is recorded unless cash is received or paid in a transaction. In accrual accounting, transactions are recorded whether it's revenue or expenses in the period in which they are incurred, irrespective whether cash changes hands or not. Accrual accounting is in line with the matching principle of accounting, which requires that revenues and expenses are matched in the period to which they belong, rather than waiting for the cash to change hands. Accrual accounting enables then to provide a true and fair view of the financial position and financial performance of the business. Here we have three possibilities or scenarios. In the first scenario, cash movement is occurring before the accounting recognition. For example, unearned or deferred revenue. Cash is received in advance before revenue is earned. In this case, cash will be debit and unearned revenue will be credit. So, unearned revenue here is a liability. Later on, when the revenue is earned, the liability will be reduced and revenue will be recognized. The entry will be unearned revenue debit and revenue credit. In the second scenario, both cash movement and accounting recognition occur in the same period. In that case, the transaction will be recorded in a single entry at the time the cash moves and the accounting recognition takes place. So the entry will be cash debit and revenue credit. In this case, there is no need to have two entries and create a liability in the form of unearned revenue. In the third scenario, cash movement takes place after the accounting recognition. So revenue here is recognized first but is not received in cash. Later, the cash is paid. However, revenue is not recognized as it is already recognized prior to the cash collection. In this case, the first entry will be accounts receivable, for example, debit, and revenue credit. This is the first entry that will be made when the revenue is recognized but not received. When the revenue is received from the accounts receivable, the entry would be cash debit and accounts receivable credit. Here we have another example, but this time instead of revenue, expense is involved. So in the first scenario, where cash movement is occurring before accounting recognition, expenses have been paid in advance. In such a case, cash is paid, so cash will be credited, and an asset will be created which will be prepaid expense. The accounting entry will be prepaid expenses debit and cash credit. Later, when the expense is recognized, the expense will be debit and prepaid expenses will be credited. If the cash movement and the accounting recognition occur at the same time, in that case again there will be a single entry where the expense will be recorded as debit and cash will be recorded as credit. In this case, there is no need to create a prepaid expense asset account. In the third scenario, the expense has accrued and the cash payment is made later. In this case, the original entry will be to create a liability for the accrued expense that will be credit and the expense will be debit. So expense debit, accrued expenses credit. This is the first entry. Later on, when the payment for the expense is made, the entry will be accrued expense debit, which is a liability and has now been paid, cash credit. So here we recorded the entry for the accrued expenses. We debited the expense and created a liability for it. When the liability was paid later, we debited the liability so that it is reduced and cash is being credited because the liability has been paid now. Here we have a simplified representation of the flow of information in an accounting system. It starts with journal entries in the journal, and then these journal entries are used to prepare journal ledger or T accounts, and the trial balance is then prepared from the journal ledger or T accounts. The trial balance may be then adjusted for any errors or omissions, and that leads to the adjusted trial balance. Then the financial statements are prepared from the adjusted trial balance or trial balance. This is what is also known as the accounting cycle. In the accounting cycle, transactions are recorded as journal entries in the journal or special journal. The journal or special journals are also called the day books, where transactions are recorded in chronological order. However, the problem with the journals is that you cannot tell readily the balance or the details of a particular account from the journal, as these entries are made chronologically in the book. Ledger overcomes this limitation of the journal as it records the same transactions not by date but by account. So if at any time you want to see the cash entries, you have to just open the cash account in the ledger book. A trial balance is a summary of the balances of the accounts in the ledger. It is considered as the first step towards the preparation of financial statements. It also helps in assessing the accuracy of the bookkeeping, that is the journal entries in the journals and the ledger book. Therefore, it helps in identifying if any adjusting entries are needed. After the adjusting entries are made, an adjusted trial balance is prepared, which is then used in the production of financial statements for the financial reporting purposes. Financial statements play a very important role in credit and equity analysis, including both stock and bond valuation. Given that accounting process involves judgment and estimate, analysts may need to make adjustments to reflect items that are not reported in the financial statements, for example, certain assets or liabilities or future earnings. In addition, they will need to assess the reasonableness of management's judgment, for example, in accruals and valuation. Because they do not have access to accounting systems or individual entries, they will have to rely on examination of the financial statements to do so. Even management may not be deliberately trying to misrepresent. Their efforts to fairly present the financial performance and position of the company involves significant judgment. Given the complexity of business model, accruals and changes in valuation of balance sheet accounts pose significant challenges. To develop a thorough understanding of the accruals and valuation policies of the business, the analyst should refer to the MD&A, that is Management's Discussion and Analysis section, as well as the Significant Accounting Policies footnote in the annual report of the company. This excerpt from the 2011 report of a company provides an illustration of how companies provide information on their accruals and valuation of balance sheet items. Detail on the specific item can be found in the corresponding note to the financial statements. For example, if the analyst is interested in knowing about the deferred tax assets and liabilities and how they are being valued, he or she should go and review note 19 of the financial statements. Similarly, this excerpt from Hershey Company's 2011 annual report illustrates how Hershey Company is informing the users of financial statements about its significant and critical accounting policies and estimates that relate to accounts receivable, accrued liabilities, pension and other post-retirement benefit plan, goodwill and other intangible assets, commodity futures contracts.